The hidden $47,000 tax break that activates at this exact age, and why 94% of retirees never use it. There's a specific age when the tax code completely changes in your favor. Not 59 and a half, not 65, not when required minimum distributions start. This age unlocks 7 legal tax strategies that can save you between $2,000 and $15,000 every single year for the rest of your life. And the shocking part? Almost nobody knows these strategies exist because this age gets zero attention from financial advisors, tax preparers, or retirement planning articles. Everyone talks about the important retirement ages. They'll tell you about 59 and a half when early withdrawal penalties disappear. They'll remind you about 62 when Social Security starts. They'll prepare you for 65 when Medicare kicks in. And they'll definitely warn you about 73 or 75 when required minimum distributions force you to start taking money out of your IRA whether you need it or not. But there's one age that gets completely ignored, an age that matters more than almost any other for tax planning, an age when specific provisions of the tax code switch on and give you access to strategies that can slash your tax bill to zero, protect your Social Security from taxation, and shield you from Medicare surcharges that can cost you thousands. That age is 70 and a half. And if you've already passed it, you need to know what you've been missing. If you haven't reached it yet, you need to know what's coming so you can plan accordingly. Before we go any further, let me be absolutely clear about something. This is not legal advice. This is not tax advice. This is not investment advice. Nothing in this content should be construed as professional guidance for your specific situation. This is educational information based on current tax law and publicly available information from the Internal Revenue Service. You must consult with a qualified tax professional, certified public accountant, or licensed financial advisor before making any decisions about your retirement accounts, tax strategy, or financial plans. Now, let me ask you something directly. Are you currently over 70 and a half years old? Just yes or no. Think about your answer because it's going to determine whether you're losing money right now or whether you have time to prepare. The difference between knowing these 7 provisions and not knowing them can literally cost you $50,000 to $100,000 over the course of a normal retirement. That's not an exaggeration. That's the actual math when you add up the tax savings, the Social Security protection, and the Medicare surcharge avoidance over 15 to 20 years. Let's get into exactly what changes at 70 and a half and why the tax code treats this age so differently. Strategy number 1, the qualified charitable distribution. This is hands down the most powerful tax reduction tool available to any American over the age of 70 and a half, period. And yet the majority of retirees who could benefit from it have never even heard the term. Here's what it is. Starting the day you turn 70 and a half, you gain the legal ability to transfer money directly from your traditional IRA to a qualified charity. Not to your bank account first, not as a withdrawal that you then donate. Directly from the custodian of your IRA, straight to the charity. This transfer is called a qualified charitable distribution. The maximum amount you can transfer in 2026 is $111,000 per person. If you're married and both of you are over 70 and a half, each of you can do $111,000 from your own IRA. That's a combined maximum of $222,000 per year. Now here's where it gets interesting. When money moves from your IRA to a charity through a qualified charitable distribution, something unusual happens. The money never shows up on your tax return as income. It never increases your adjusted gross income. It never increases something called your provisional income, which determines how much of your Social Security gets taxed. It never triggers Medicare surcharges. And once you reach the age when required minimum distributions start, the qualified charitable distribution counts towards satisfying that requirement. The money is completely invisible to every single tax calculation the IRS runs on your return. Think about what that means. Let's say you normally give $10,000 per year to your church. Under the normal approach, you take $10,000 out of your IRA as a withdrawal. That $10,000 shows up as income on your tax return. It gets added to your adjusted gross income. It pushes your provisional income higher. That higher provisional income can push up to 85% of your Social Security into the taxable zone. If you're in the 12% tax bracket, you pay about $1,200 in tax on that $10,000 withdrawal. But it gets worse. Because that withdrawal pushed your provisional income higher, more of your Social Security became taxable. That additional tax might be another $500 to $1,000. So the real tax cost of withdrawing $10,000 from your IRA to donate to charity is actually between $1,700 and $2,200. Now compare that to the qualified charitable distribution approach. You contact your IRA custodian and tell them to send $10,000 directly to your church. The money goes straight from your custodian to the charity. It never touches your bank account. It never appears on your tax return. Your provisional income stays exactly where it was. Your Social Security taxation doesn't change. Your total tax on that $10,000 donation is exactly $0. Same charity, same amount, same impact, but you just saved between $1,700 and $2,200 by changing the route the money took. If you give any amount to charity and you are over 70 and a half and you are not using qualified charitable distributions, you are literally handing the IRS money you don't have to give them. The process takes about 15 minutes. Every major IRA custodian has a form for it. You fill it out, name the charity, they send the check, and you save real money every single year for the rest of your life. Let me show you a real example with actual numbers. A married couple, both 72 years old, gives $8,000 per year to their church and $2,000 to a local food bank. Total charitable giving is $10,000 per year. They've been writing checks from their bank account for 20 years because nobody ever told them there was a better way. Their annual income looks like this: Social Security benefit of $38,000, IRA withdrawals of $25,000 to cover living expenses, interest from savings of $3,000. To calculate provisional income, you take the IRA withdrawal of $25,000, add the interest of $3,000, and add half their Social Security, which is $19,000. That gives provisional income of $47,000. For married couples filing jointly, if provisional income exceeds $44,000, up to 85% of Social Security becomes taxable. This couple is at $47,000, so they're in the 85% zone. That means approximately $21,840 of their $38,000 Social Security benefit gets taxed. Now watch what happens when they switch to qualified charitable distributions. Instead of withdrawing $25,000 from the IRA and writing checks from their bank account, they withdraw only $15,000 for living expenses. The other $10,000 goes directly from the IRA to the church and food bank as qualified charitable distributions. Their adjusted gross income drops by $10,000. Their provisional income drops from $47,000 to $37,000. They slide from the 85% taxation zone into the 50% zone. The taxable portion of their Social Security drops from $21,840 to approximately $5,000. Their federal tax drops by approximately $2,000. Same lifestyle, same donations, same charities. They just changed the path the money took, and that saved them $2,000 in federal taxes. Over 10 years, that's $20,000 saved. Over 20 years, it's $40,000. There are 3 critical mistakes people make with qualified charitable distributions that cause them to lose the tax benefit. Mistake number 1. They have the custodian send the money to them first, then write the check to charity. This does not qualify. The money must go directly from the custodian to the charity. You cannot touch it. Mistake number 2. They try to use a qualified charitable distribution to fund a donor-advised fund. Donor-advised funds do not qualify. The money must go to an operating 501c3 charity like a church, food bank, homeless shelter, university, or hospital. Mistake number 3. They make the qualified charitable distribution one day before they turn 70 and a half. The IRS is absolutely strict. You must be 70 and a half on the exact day the distribution is made. Check your exact date before your first qualified charitable distribution. Strategy number 2. The one-time qualified charitable distribution to a charitable remainder trust. This one is brand new. The Secure 2.0 Act created a provision that allows you to make a one-time qualified charitable distribution of up to $55,000 from your IRA to fund either a charitable remainder unit trust, a charitable remainder annuity trust, or a charitable gift annuity. This is a lifetime limit. You can only do it once. But for the right person, it's incredibly powerful. Here's why this matters. A charitable gift annuity or remainder trust is an arrangement where you give money to a charity, the charity invests it, and the charity pays you income for life. When you die, whatever remains goes to the charity permanently. Normally, if you wanted to fund one using IRA money, you would withdraw the money, pay income tax on the entire withdrawal, and then contribute the after-tax amount. On a $55,000 withdrawal in the 22% tax bracket, you'd pay $12,100 in federal tax. You'd also trigger additional tax on Social Security. The total tax cost could easily be $15,000 or more. With this new provision, you fund it directly from the IRA through a qualified charitable distribution. No income tax on the transfer. The full $55,000 goes to the charity. You start receiving income payments, and the IRS gets nothing on the initial transfer. The tax savings on the transfer alone at a 22% rate is $12,100. When you add avoided Social Security taxation and Medicare surcharge exposure, the total benefit can exceed $15,000 on this single transaction. This requires working with a charity that offers these arrangements. You need to understand the payout rates and terms. Once you do it, you can't undo it. But for charitably inclined retirees with large traditional IRAs who want guaranteed income while supporting a cause, this is one of the most tax-efficient options available. Hashtag strategy number 3, the pre-required minimum distribution window. This is the strategy almost everyone completely misses because they don't understand how the calendar works. Qualified charitable distributions start at age 70 and a half. Required minimum distributions don't start until age 73 if you were born before 1960, or age 75 if born in 1960 or later. That gap is a window. For some people, it's 2.5 years. For others, 4.5 years. During that window, you can use qualified charitable distributions to strategically reduce your IRA balance before the IRS starts forcing money out. Why does this matter? Because required minimum distributions are calculated based on your IRA balance as of December 31st of the prior year. The higher that balance, the higher the forced withdrawal. The higher the forced withdrawal, the more Social Security gets taxed, the more likely you trigger Medicare surcharges, and the higher your effective tax rate. If you use qualified charitable distributions during this window to reduce your IRA by $50,000 to $100,000, your future required minimum distributions shrink proportionally. On a $100,000 reduction, your first required minimum distribution drops by approximately $4,000. That's $4,000 less in forced taxable income every year. That keeps provisional income lower, keeps more Social Security non-taxable, and potentially keeps you below Medicare surcharge thresholds. Let me show you the math. A retiree turns 70 and a half in 2026 with a traditional IRA of $500,000. Born in 1960, required minimum distributions start at 75. That's 4.5 years of window time. If she does qualified charitable distributions of $15,000 per year for 4 years, she reduces the IRA by $60,000. At age 75, assuming normal growth, her balance is approximately $510,000 instead of $570,000. Her first required minimum distribution drops from approximately $23,170 to approximately $20,732. That's approximately $2,438 less in forced taxable income every year for life. At 12% tax bracket, that saves approximately $293 per year in direct tax. But the cascade effect on Social Security taxation saves another $400 to $600 annually. Combined annual savings is approximately $700 to $900. Over 20 years, that's $14,000 to $18,000 in total tax savings. Strategy number 4, The last clean Roth conversion window. If you're 70 and a half, you have between 2.5 and 4.5 years before required minimum distributions begin. This is the tail end of the gap years, and every year of conversion space remaining is precious. Once required minimum distributions start, Roth conversions don't stop being possible, but they become much harder to execute efficiently. Your required minimum distribution must be taken first before any conversion. The IRS is strict about this. So that required minimum distribution fills the lower tax brackets. Then the conversion stacks on top, often landing in the 22% bracket or higher. At age 70 and a half, if your income is controlled, you might have significant room in the 12% bracket. You might convert $30,000 to $50,000 per year at 12%. But at 73 or 75, when the required minimum distribution fills $15,000 to $25,000 of that space automatically, your conversion room at 12% shrinks dramatically. Every dollar you convert at 12% now saves you 10 to 18 percentage points on that dollar later when it would come out as a required minimum distribution at an effective rate of 22% to 30%, including Social Security taxation cascade. On a $50,000 conversion, that's $5,000 to $9,000 in lifetime tax savings. Let me show you why the math changes once required minimum distributions start. At 70 and a half, with no required minimum distributions yet, a single filer with Social Security of $30,000 and $2,000 in savings interest has taxable income after the standard deduction of approximately $13,850. She is in the 12% bracket with over $36,000 of room before hitting 22%. She can convert $36,000 at 12%. Total conversion tax is approximately $4,320. Now fast forward to age 75, when required minimum distributions start. Same Social Security, same interest, but now her required minimum distribution of $18,000 is forced into the brackets first. After the standard deduction, her taxable income before any conversion is approximately $31,850. She has only $18,550 of 12% space left. Her conversion capacity at the lowest rate just dropped by nearly half, and it gets worse every year. At 80, the required minimum distribution percentage is higher. At 85, higher still. By 85, the required minimum distribution alone may fill most of the 12% bracket, leaving almost no room for conversions at favorable rates. There's also the Medicare surcharge consideration. Every dollar of Roth conversion counts toward modified adjusted gross income for Medicare. At 70 and a half, if your modified adjusted gross income is below $109,000 as a single filer or $218,000 married filing jointly, you can convert up to those thresholds without triggering Medicare surcharges. But remember the 2-year look back. A conversion you do at 70 and a half in 2026 affects your Medicare premiums at 72 and a half in 2028. Plan the conversion amount with one eye on the tax bracket and the other on the Medicare surcharge tier. Hashtag strategy number 5, the new code Y on your 1099-R. This isn't a strategy you implement. It's a reporting change that solves a problem retirees have dealt with for years, and almost nobody knows it happened. Starting with the 2025 tax year, the IRS introduced a new code for Box 7 of Form 1099-R. That code is the letter Y. It specifically identifies a distribution as a qualified charitable distribution. Before this code existed, qualified charitable distributions were reported as regular distributions on your 1099-R. Tax software would see them as taxable income. You had to manually exclude them on your return. If your software didn't handle it correctly, or if your preparer didn't catch it, you would pay tax on money that should have been tax-free. This happened constantly. Retirees would do a qualified charitable distribution in good faith and then discover in April that their software included the distribution as taxable income. They overpaid. Many never caught the error. Code Y eliminates that problem. When your custodian sends the 1099-R with code Y in box 7, tax software knows automatically that this was a qualified charitable distribution and excludes it from income. No manual adjustment, no room for error. If you did a qualified charitable distribution in 2025 or earlier and your preparer included it as taxable income, you may have overpaid. You can file an amended return within 3 years to claim a refund. Check your 1099-R from 2025. If the qualified charitable distribution is listed with code Y and it was included in your taxable income, that's money the IRS legally owes you back. Hashtag strategy number 6, Social Security maximum benefit and provisional income management. If you delayed claiming Social Security until age 70, your benefit is now at its absolute maximum. For every year you delayed past full retirement age, your benefit grew by approximately 8%. By 70, your benefit is 132% of your full retirement age amount. That increase is locked in permanently with cost of living adjustments on top. At 70 and a half, you've been collecting that maximum benefit for 6 months. Now the question shifts from when should I claim to how do I protect what I'm getting from being taxed? The answer is provisional income management. And 70 and a half is when this becomes the most important calculation in your financial life. Your provisional income is your adjusted gross income plus any tax-exempt interest plus half of your Social Security. If you're a single filer and provisional income exceeds $34,000, up to 85% of your Social Security becomes taxable. For married couples filing jointly, the threshold is $44,000. At 70 and a half, with a maximum Social Security benefit of approximately $40,000 per year, half of that is $20,000. That $20,000 goes into provisional income before you've withdrawn a single dollar from any other account. You only have $14,000 of breathing room before you cross the $34,000 threshold. This means every dollar of additional income matters enormously. A $10,000 IRA withdrawal pushes you to $34,000 and triggers the 85% taxation zone. A $10,000 qualified charitable distribution instead keeps you at $24,000, well below the threshold. The qualified charitable distribution kept your Social Security tax-free. The IRA withdrawal would have made $20,000 of your Social Security taxable. At a 12% tax rate, that's $2,400 saved every year from one decision about how to move $10,000. This is why 70 and a half matters. The qualified charitable distribution becomes available exactly when provisional income management becomes critical. The two provisions work together perfectly, and the IRS doesn't explain the connection. Hashtag strategy number 7, the senior bonus deduction stacked with everything else. In 2025, new legislation created a $6,000 deduction for taxpayers age 65 and older. For married couples where both are 65 or older, it's $12,000. The deduction phases out at $75,000 of adjusted gross income for single filers and $150,000 for married filing jointly. At 70 and a half, you're well past 65, the deduction applies. But the real power isn't the deduction by itself. It's the deduction stacked with qualified charitable distributions and Roth withdrawals. Here's how the stack works. Let's say you need $50,000 per year to live. Social Security covers $30,000. You need $20,000 more. Instead of pulling that entire amount from your traditional IRA, you pull $10,000 from a Roth IRA. That's completely tax-free and invisible to the IRS. Then you do a $10,000 qualified charitable distribution from your traditional IRA to charity. That's also invisible. Your adjusted gross income is essentially just your Social Security. Your provisional income is $15,000, well below the $25,000 threshold where Social Security taxation begins. 0% of your Social Security gets taxed. The senior bonus deduction reduces taxable income even further. Your federal tax bill is effectively zero. You lived on $50,000 and paid zero in federal income tax, legally, because you stacked 3 provisions that all become available by 70 and a half. Compare that to the retiree who pulls the full $20,000 from a traditional IRA. Their provisional income jumps to $35,000. They cross the $34,000 threshold. 85% of their Social Security becomes taxable. Their federal tax bill is approximately $2,000 to $3,000. Same income, same lifestyle. One retiree pays zero. The other pays $3,000. The difference is knowing three provisions and how to stack them. The IRS will never explain this combination. Tax software will never suggest it. Most tax preparers won't model it unless you specifically ask. And if you live in one of the 8 states that still tax Social Security in 2026, Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, or Vermont, the stacking strategy saves you at the state level too. One critical warning about the senior bonus deduction: it's temporary. It runs from 2025 through 2028 only. After 2028, unless Congress extends it, the deduction disappears. If you're 70 and a half right now in 2026, you have 2026, 2027, and 2028, 3 years. At $12,000 per year for a couple, that's $36,000 in total deductions, saving approximately $4,320 at the 12% rate. After 2028, that savings is gone. 3 action steps you can take right now. First, if you give to charity in any amount and you're over 70 and a half, contact your IRA custodian this week and set up a qualified charitable distribution. Every major custodian has a simple form. It takes about 15 minutes. Start with your next charitable gift and route it through the IRA instead of writing a check. Second, calculate your provisional income right now. Take your adjusted gross income, add any tax-exempt interest, add half of your Social Security. Where do you land relative to the $25,000 and $34,000 thresholds? If you're above $34,000, look at how much could be replaced with Roth withdrawals or qualified charitable distributions. That number represents money you can legally claw back from the IRS. Third, check your 2025 Form 1099-R. If you did a qualified charitable distribution last year, look for code Y and box 7. If it's there and your return still included that amount as taxable income, you overpaid. You can file an amended return to get that money back. The window at age 70 and a half is real. The tax savings are real. The strategies are legal and fully supported by the Internal Revenue Code, but nobody is going to explain them to you unless you ask. And by the time most people figure it out, they've already lost years of potential savings. If you're 70 and a half or older, you have access to these strategies right now. If you're approaching 70 and a half, you have time to prepare and structure your accounts to maximize the benefit the moment you're eligible. Understanding what changes at this specific age can save you tens of thousands of dollars over your retirement.